Hey everybody, just doing a quick live stream. So if anybody wants me to do a DCF, let me know the ticker. Ed, what's up? And I could run it. I thought I would talk about stock buybacks. It's probably going to be boring. I'm sure a lot of people will stop watching because I haven't practiced. I know how it works, but I'm going to end up tripping myself up. I know it, trying to explain it, but I'll try to explain it anyway. Somebody asked me, because I mentioned on my channel, I wrote like a little blog saying if you want to be part of my live stream, just email me and I could send you the link and we could do it together. Even if you don't know anything about stocks, you could just be part of the live stream and it'll be an interesting experience. So Paul contacted me. Petco, that's an interesting one. Petco, I think I do like the concept. Let's wait for more people to come on. Let me see if I could explain how buybacks work. I know most of you know how buybacks work. Not everyone. I'm sure there's some people that aren't too sure how it works, but I think most people understand the concept of buybacks. So if like we'll just go with, hey Constantine, what's up? How's it going? Everybody sub to Constantine. He's really, really knowledgeable. I like his channel. Mark, what's up? So I mean, just it's good to understand the high level of things, because if you understand the high level, it makes it a lot easier to understand the minutia. Of course, it could take you decades to understand things thoroughly, but just understanding how things work on a basic level is 10 times further than everyone else. So if a company has like, technically I might not say this exactly right, but just I'm trying to get the point across when I explain things. I know there's always going to be like nuances. If I try to explain every nuance, no one will follow. So I'm trying to keep it high level. Just say there's a company that has 1 million shares outstanding and price per share is $5. So if 1 million shares outstanding, price per share is $5, what's the market cap of this company? Does anybody know? Can somebody tell me? I know Constantine, I know you know the market cap. Constantine probably knows the market maybe better than me. He's really knowledgeable. But did anybody know what the market cap of this company is? We have all the information we need. Stink bid, what's up? So what's the market cap? Market cap is just the value of the company according to the stock market. 5 million, exactly. Okay. So 5 million. I can't stand this. You'd be surprised how a little confusing it is to do share buybacks, but you'll see what I mean. Market cap. Yeah, anytime, Constantine. It's always nice to have somebody on the stream with me because I'm not the best speaker. I mean, I try, but I'm not an outgoing person, so it's a little tough. But you just gotta do it, right? And try to ignore your insecurities. So yeah, the market cap is $5 million. So let's just say they bought back a big buyback. They made a lot of cash. They wanted to buy back 10%, 100,000 shares, which is a pretty big buyback, 10% of your company. That probably wouldn't happen, but so before the buyback, the market cap's 5 million. They buy back 1 million shares. So after the buyback, they now have post buyback. They now have 900,000 shares. So what's the market cap of the company now post buyback? and I know it's not going to work out perfectly like this because the market is not a perfect it's not, the efficient market hypothesis doesn't work perfectly. The market, there's always these things happen in the market where things don't move correctly, but generally what would be the market cap of the company post buyback? What do you think? Mark says 4.5 million. What do you think? Constantine, what would be the value of the company post buyback? And I get it, like we don't know how the market reacts to things, but we're just gonna assume there's no market reaction. There's no it's not a lot of bullish activity or bearish activity. The market kind of works perfectly in this situation. So Constantine, why do you say 4.5 million? Because the company has less cash? Wouldn't it still be 5 million? The value of the company? Why would the value of the company decrease? So post buyback, it would probably stay at 5 million. And each shareholder would own, the share price would be 556. So yeah, so the price each, who's sending me private chat? So pre-buyback, 1 million shares, $5 per share. Market cap is 5 million. Post buyback, it stays at 5 million. The market cap, and now there's less shares to spread over that 900,000. Now there's 100,000 less shares to spread across that $5 million market cap. So the post buyback. Oh, Paul's here.
Hi.
Paul, what's up? Thanks for joining. So, Paul, so how long have you been investing or following the market?
Um, I'm retired and I've never really paid attention to it. I kind of, as I said, told you in the email, that I feel like I'm just looking at different news and stuff and seeing what stocks they're picking and trying to follow along and not doing my own due diligence. So accordingly, I'm suffering on my yields. So I'm kind of feel like I'm floating on the waves, uh, uh,
Right.
victim of uh, whatever the powers that be are marketing, or they're selling this stock, or they're, you know what I'm saying, just
Yeah.
so
I think
I'm just feeling like the game is a little fixed,
it's
and that
it,
we're the
yeah.
PT Barnum suckers born every minute.
Um, I mean, I guess if you're losing money, then I guess I would yeah, you might think it's fixed. It's against you, the market. But when you're making money, it might seem like a different story. If you're not sure about investing, just buy an index like the S&P 500 or another index.
Yeah, that's what
I
I
think that's
was thinking. That's the lazy way to do it, or the less stressful way to do it.
you're trying to buy individual stocks and like beat the market. What stocks have you bought?
Oh, actually, I haven't looked at my portfolio in years, but I was buying, I was buying AT&T because I for the yield, and
Right.
I bought some Walgreens. I bought some Costco, which was pretty good. But I turned them over when there was a little profit. I sold them. So I didn't know. I was kind of hearing that buy and hold was no good. So you got to kind of get in and get out, or play the cycle, whatever.
Oh, like
So I don't know what I'm doing. So let's just say that.
like a trader, like you buy and sell over and over. You like
Well,
is
I wasn't day trading, but it's sort of just looking at, because I got started during the COVID pandemic, right, when everybody was home.
right.
So, and then there was a big push at the time with all the brokerage companies, like what are they? Webull, and I forget all the names. They were all uh,
Yeah.
pushing the market, getting the average investor to get into the market. And so I did. And before that, I was just using Vanguard. And then we thought, well, the returns are so modest that maybe we should try, you know, going going with more individual stocks. So
Yeah, if anybody doesn't know or is not comfortable, I mean, I don't feel like I know what's going to go up or down. Um, I have ideas, but I just think just buy the S&P 500, SPY, or a different index, basket of stocks. Because even if a few default or a few companies go down 50%, you're because people generally buy and sell at the wrong time. Um, when a stock goes up, people buy it because they think it's going to go up forever, and when it goes down, people sell it because they think it's going to go down forever. Um, but that's usually the opposite of what they should do. Um, when it goes down is when you should start buying it, and when it goes up is when you should start selling it. Um, so that's why it's just easier just to buy the index and not even do anything else. Um,
okay, that's that sounds good.
Stay clear stock. Yeah, because I mean, if you buy something and it goes up a lot, it sounds like you just want to take in your gains and you sell it right away, or not right away, but you sell it when it goes up to try to capture the profit. Is that what you did for Costco?
You're talking to me?
Yeah.
Oh, well, during that time, I was just, yeah, I was looking up. Oh, it went up $4 or $5, so I sold it. What's something else? And then even started looking at some Chinese stocks, and because they were even more volatile, but they were being hyped so much. So I was just like floating on the waves, of whatever was people were talking about. And I wasn't doing the correct valuations, looking more long term and such, because I feel like that was a lot of work to have to read the quarterly reports, what they call 10K or something,
Yeah.
and try to understand it, because you need basically to uh, create a financial background where you start understanding what these things are talking about. And even if you get some news, you don't really know how to interpret it. You don't know what they're promoting. You know what I'm saying? Like, I feel like all the news is just triggered to just trigger you to do something. Yeah. So, and that push you off your position. So that's kind of how I feel like the game is not uh, not for the faint of heart. You've got to weather the ups and downs.
Do other people feel that it's fixed the market and only certain people have information and everybody else? The fuck? I mean, I maybe to a point, I guess people who have inside information, but it's fixed towards them, but that's illegal. So, I mean, pretty much everyone has the same information out there. There's not like if you buy a stock, nobody knows that. Like, there's no like way for someone to know that and then get and make the price go lower just because you bought it. So I mean, it's just like I said, you just want to if you can't. I mean, I think buying and holding is the only real good strategy. Like trying to find good companies first, and not selling, because like when I had Meta, I mean, a lot of people would have sold their Meta because I had a lot in Meta. And I bought it I bought it two different times, but in 2017 I got it like a 150, like 155 in 2017, and then it was up to 380. So if I didn't sell by then, which most people would have, then it fell below 100. So I went from being up 200% to being down 50%. And most people would have just, if they did hold through that, they would have probably sold as soon as they broke even again.
Right.
Because a lot of people,
they're emotionally worn out.
when they're down in a stock, they just want to get back to break even, which isn't a good strategy. Because if you're holding a stock, you should think to yourself, if I had X amount of money, would I buy the stock today? And if the answer is no, then just sell it, even if selling at a loss, and buy something that you would buy. Don't just hold it because you're down 20% and you want to get your money back. I mean, if you're like, when I was down on Meta, even though I was up a ton of money, then I was down, I still would have bought it. I mean, I do kick myself for not buying more of it when it was real low. But now I'm up. Now I'm up a ton. It's trading higher than ever. But I sat on it for 7 years. Because I had faith in the company. If you withdraw money from a business via buybacks, the market cap cannot remain the same as the company had the money in. Yeah, Costine. Yeah, I guess you're right. I probably didn't. But I just would stick to index funds. It's too risky. If you're too influenced by the market, then
Right.
just buy index funds.
Yes.
But don't sell them when they go up or down, because the market will go up in the long run.
Do index funds pay off dividends, or they just?
Yeah, I think the S&P 500. Wait, that does. Well, it's. Yeah, I think the S&P 500 pays a dividend. 1.37%.
Okay.
Everybody, the index funds. Okay. S&P 500 does not pay a dividend. There are some mutual funds does not pay a dividend. However, there are mutual funds, exchange traded funds that track the index, which you can invest in.
So what was that 1.37% you were looking at? Is that yield?
I guess that's the return.
That's the return from the beginning of the year, or from?
I don't know what the time frame is.
Or 1 year, or the year to date return below it is 5.45. Yeah, that's what I mean. You have to really understand.
Maybe it's a 1 month. I don't know.
Okay.
But
it must not be important if you don't know it. Okay.
I don't really look at dividends too much. Sometimes, but I know if you own S&P 500, you can see overall it goes up. Well, it's trading at its highest point ever. Okay, so the yield is a theoretical dividend if you did receive a dividend. Okay, thanks, Costine. But you don't get that dividend. It's just put back into the. It's contained within the share price.
So this is a basket of stocks that are bought, right? And some of them have dividends.
Right.
And so they don't pay back that dividend to you, but they include it in the yield. I mean, the way it's going up. What do you call
the stock price. It's as if you own a stock, and if they pay you a dividend, but you just turned around and bought more shares with the dividend. That's kind of like what that is.
It's like a reinvestment of the dividends.
Yeah. Yeah.
Okay.
And then the year-to-date return is just so far from the first 5 weeks of the year. That's the return on the share price. But the people, when people invest, if they see results, then they love investing and they keep investing. But if they lose money, even if it's over like a month or two, like I know a lot of people who got like an inheritance of 50,000 and say they invested it say anytime between mid 2018 or February 2020, anytime between that time frame, those that two almost a year and a half. If they received any money in that year and a half time frame, by the time it hit the bottom of COVID, they would have lost money. Whether they bought it here or here or here, they would have lost money. And then once they see a negative, sometimes they wait a week or two or a month, but if it doesn't rebound quick enough, they just sell and they never invest again. That's what most people do. Okay, see ya, Cosentine.
So dollar cost average into the S&P might be a strategy.
Yeah, some people dollar cost average. It's up to you. Whenever I have money to invest, I just invest it. I invest it right away. I don't wait, invest a little at a time. But you could. Some people take like $500 out of their check each month, or whatever amount they can handle each month, and then invest that. So every month they invest 500 into the S&P 500 or 1,000, whatever dollar amount. So that's a good way to do it. Like you force yourself to save a certain amount of money each month, and just put it into something like an index fund, not an individual stock. And you're going to make money. I mean, there's going to be times like, even say you started in 96 and you did $500 a month. By 4 years later, you would have been really happy because you would have been up a lot. But 3 years after that, you would have been back to where you started. So you would have been like, I wasted 6 years investing, and now I'm back to where I started pretty much. So most people would just give up. They'd be too stressed out. But then if you waited another 4 years, you would have been back up to your highest level ever. Then you would have been happy. But then a few years later, you would have been down like 40% from your original investment. So people just, when it goes down, they just give up because they think it's just going to keep going down forever. But you can see the people who waited out, like I waited out, like I've been investing a long time, but I didn't have that much money until maybe 2010. Before that, I wasn't making that much money, and I had to, live and stuff, and I didn't have extra cash. But so I'm pretty much in it for the long haul. What does everybody think? I think that's the only way to make money is long term. If you try to time the market, I don't think it's possible to really, unless you are really, really good and you have, balls of steel.
No, not me.
It's hard to do that. So what I was saying before, I was trying to do buybacks. Maybe it's just easy to, instead of through example, because then it got confusing. So when a company buys its own shares, so if a company has 10,000 shares, which I know is not a lot. Most companies have millions and billions of shares. And they buy 1,000 of those shares. Now there's 9,000 shares in the market. And they remove those shares and put onto a balance sheet as treasury stock. So say each share was $1. So they would report negative $1,000 as treasury stock in the equity section of their balance sheet. So if a company had 10,000 shares, it was $1 per share. And their cash goes down by $1,000. If they bought back 1,000 shares at $1 a share, so if their cash, say their cash before the buyback was 13,000, let's just, I gotta fill in this stuff. So they had, this is, it's hard to read. Oh boy. Let me do this. Come on. The fuck? Okay, say a company had,
You can drag the A to make it wider. It might be easier to see at the top. Yeah.
it was just formatting was all messed up. Okay, so okay. Okay, so let's just say a company's balance sheet had 13,000 of cash, 2,000 of accounts receivables. So their total assets were 15,000. The fuck? And let's just say their only liability was accounts payable. And they had 11,000 accounts payable. So their retained earnings was 4,000. Okay. Okay. So this is the company's balance sheet. Okay. I guess we'll make it. Okay. So everybody knows the balance sheet is assets minus liabilities equals equity. So this company has 4,000 of equity. They have assets of 15,000, liabilities of 11,000, and equity of 4,000. Now let's say they wanted to buy back stock. They had 10,000 shares, and they wanted to buy back 1,000. Okay. Per share. Okay, it's $1 a share, and they wanted to buy 1,000. So cost to buy back. So does everybody, you guys a comment? Does that make sense?
Yes.
Okay. So if a company has 10,000 shares, and I know if you want to just add some zeros, because I know companies aren't this small in the stock market, but just to explain it, and they wanted to buy back stock because they had a lot of extra cash from running their business. Each share is trades for $1. They wanted to buy back 1,000 shares, which means they would have to spend $1,000. So how would they do that? Well, cash. Let me. This is just our reconciliation to confirm we're doing things correctly. So if they wanted to buy back 1,000 shares, it would cost them $1,000. That cash would go down $1,000. That's what happens when a company buys back stock. So minus $1,000.
You don't have a sum on the total assets.
Okay, that's why it's not working. Okay. Okay, okay, I don't want to connect that. Okay. So the cash goes down $1,000. So now assets do not equal liabilities plus equity, because assets is 4,000, liabilities plus equity is 15,000. So we're off 1,000. What happens? Treasury stock, which is a contra equity account, which contra means it acts the opposite of a normal account. So it reduces the value of your equity. So now it balances. Assets equal liabilities plus equity. So when a company buys back its own stock, its cash goes down. So actually its balance sheet, in a sense, gets worse, even though it helps the shareholders, because there's less shares out there. So if the price of the stock goes up in the market, or they pay a dividend, there's less shares to spread across that amount. So, like, for instance, if the company paid they had $10,000 in dividends to share. This is pre-buyback. That means each shareholder would get well, maybe that's too much. Let's do 1,000. Say they had $1,000 to spread across
10,000 shares.
So each shareholder would get 10 cents. If for the whole year they wanted to pay $1,000 in dividends, so they paid every year they paid a dividend, only once a year. So they had $1,000 to give. So each shareholder would get 10 cents. So if you own 5 shares, you would get 50 cents in dividends. Say that's the 2023 dividend. $1,000. Okay, dividends paid, shares, div per share. So in 2023, hey Dex, Wegro. So in 2023, this is before the buyback. At the end of 2023, they see how much cash they have left over, and they give $1,000 to the shareholders. There's 10,000 shares out there. So if you own one share, you get 10 cents. If you own 10 shares, you get $1. Now let's just say in 2024, they still, at the end of 2024, they could still only pay 1,000 in dividends, same as last year. They have $1,000 left over, which they can give to the shareholders. But now there's less shares out there, right? There's not 10,000 anymore. There's 9,000 shares. So why does that not work? Okay. So they could spread that $1,000 over less shares. Because if a company buys back its own stock, which happens a lot, the company doesn't get smaller. It's not like the company closes factories or sells less product. They're just decreasing the shares outstanding. So they could still be the same exact business and be just as profitable as prior years with less shares. So that's one of the big benefits of buybacks is there's less shares to spread over the profit. And it's the same thing. Is that clear? Because that's kind of like the real basic concept of buybacks. Dividends make sense, but to add a step further, say, well, I don't want to do this as an example, but say it was in mid 2020, because in 2023, if the stock went up, it went up like 10% in a day. The share price, like the share price went up 10%. Well, it's the same concept, because if there's less shares, then each shareholder gets more in 2024 if a stock goes up 10% than in 2023, because there's less shares to spread across. I think it's just easier to explain in dividends because it's a little clearer. So if they bought back 1,000 shares, they kept doing that, and they did that in 2025, same thing. They bought back 1,000 shares, and they still paid their $1,000 annual dividend. The shareholders would be happy because they're getting more. Because if you just own one share, in 2023 you get 10-cent dividend. 2024 you get 11 cents. 2025 you get 13 cents. So you're getting more with that one share. The opposite happens when they add shares. What if a company is diluting shareholders? So what if there's a similar company, they pay $1,000 each year in dividends. They start off with 1,000 shares, but they're adding shares each year because they need money. So they add 1,000 in 2024, and in 2025 they add another 1,000. So say you own this is company X, and you own one share of company X. And this is company Y, and your friend bought company Y because they like company Y better. So your dividend goes up each year by owning company X. But your friend owns company Y and he's getting less dividend each year. And both companies are paying $1,000 for the whole company. That makes sense, right, Paul? Or is that confusing?
Yeah.
I think that's the clearest way. But it's the same concept if the stock price goes up in the open market. Like if Meta was going up a lot, and then if the company never bought back so many shares because they
You're frozen.
Okay, I think I'm back.
Okay.
I prefer buybacks dividends. Yeah, Wegro, I also prefer buybacks dividends. So it's a little more confusing understanding buybacks in terms of market price fluctuations, but it works the same exact way as dividends. But dividends is a little more tangible. It makes a little more sense. But it's the same thing as if it's a really bullish market. And if the company bought back a ton of shares, your stock price would appreciate a lot more. Okay, but anyways, just to understand the
Well,
actually, I'm gonna can you I'm gonna be back in 2 minutes.
Okay.
Paul, can you tell us about your history, like what you did for a living, and just give them a little background?
Well, I was a software engineer working on websites. I started off on mainframe computers back in the 70s, moved to the PCs in the 80s, and kept trying to move with the industry. So I did okay. I didn't as some have go to Silicon Valley and get a windfall by investing in stocks for those companies. But I was never that aggressive. So I'm just here to try to learn and try to figure out a way to keep my current portfolio moving with inflation. I'm really concerned with inflation eroding my retirement dollars. And I'm sure many other people are still very worried about inflation too. So, hey, Scott.
Yeah.
How does inflation affect the market and your strategy?
The thing I love about stocks is that inflation really helps stocks because, I mean, what inflation is, it's a tax on your cash. It makes your cash go down in value. So if you have $10,000 and you just keep it in your house, and the year is 2020, and then in 2025, that $10,000 that's sitting in your drawer can't buy nearly as much as it could have in 2020. So it's just it's taxing your cash. Your cash is getting worthless every year. So it's just a tax on your savings. So in order to fight inflation, you have to put it into something like a stock or real estate or something that appreciates in value. Obviously, we don't know what's going to appreciate. Some things actually might go down in value. But if you leave it in a savings account, or if you leave it in an account that gives you 1% interest, you just lose more and more money each year. So that's why the market goes up. Inflation, things cost more. So it has to go up over time. Unless we live in Venezuela or South Africa where they have deflation and the economy is shit. And that's why the stocks market has boomed a lot. My portfolio, I think it was mainly for Meta, is up about 50% in like a year, like the past year, because
Nice.
I think because of inflation. I did get lucky with Meta because it went up 4x, and I'm really heavy in it. Um, but but even just put in the S&P 500, everything is at its peak. Um, of course, if you invest in like if you were if you were in 1980 and you put all your money into companies that make VCRs, sure, by 2000 your investment is nothing because it's obsolete. So you got to at least invest in companies, but who can predict the future, right? I mean, I can't predict the future, but that's why I invest in companies that make sense to me. If somebody, there's a lot of companies that people bring up, and I say it just doesn't make sense to me. I'm not saying it won't go up in price. Everybody needs to eat. Not every restaurant makes money, of course, and not everybody needs fine jewelry, high-end jewelry, but there's plenty of high-end jewelry stores that are making tons of money. So you just gotta. First thing I do is I make sure the product makes some sense to me. Things that make sense to me are companies that sell like oil. Oil makes sense. Companies that make cars, that makes sense to me. Like supermarkets make sense to me. Like a company I brought up before, like BarkBox, where and I used to be a member of BarkBox, where I would pay $20 a month, and they would send me a box, and inside the box would be a little dog treat, a dog toy, a couple of things for my dog, and I liked it. I thought it was a cool product, but it didn't really make sense as an investment, and that's why it's probably down 90%. It's a nice business, and there's plenty of businesses out there that can employ people and give people jobs. But for investment, I didn't think that was a great investment. Same thing with like Tesla. Tesla, I mean, they make a great product with demand, but it's not a selling cars is not like a profitable business. It's like aircrafts. It's not a profitable business. It's always going to be around because we need aircrafts. We need airplanes to live. We couldn't function as a society without them. But it's a killer industry. They just generally lose money overall, and they always need support from the government or whatever. That's why I like companies like tech companies are very scalable, and a company like Meta or Google is just all profit. And but that's we get into a whole big thing about that.
And they're branching into AI
And
software.
AI is big, yeah.
That's why they have a even better future, right?
Yeah. But there's plenty of tech companies that like you could have like Intel. And Intel was by far the biggest semiconductor company in the world, and they were in 2000 they were bigger than the 5 other semiconductors combined, second, third, fourth, and fifth. Like they were bigger than pretty much the entire market combined. They were the biggest. Intel, look how much the stock price was in 2000. They were killing it. Now they're just like now they're like in 6th place, way behind Nvidia. So just because they're in an industry that's really important, semiconductors, and they're part of the AI boom, you also need a company that runs a good business. And it's hard to know, right? Who would have known they would have fell off the face of the earth? I mean, they're not a bankrupt company for any means, but they went from, look at this, 70 down like what 65%, and then for the next 2 decades, and this is in 2002, so you have to pull it out even further. So it did come back up, but so in 25 years, I mean, if you were unlucky to buy it above 60, you're still down, and it's 25 years later. Even if you bought it in the 30s and 40s, it did come down to that level. So it's not really. It's hard. It's like, how do you know? That's why. But
Yeah, I grew up with Intel. They were the kingpin, and nobody thought they would fall off the mountain. And but then the ability to produce the high end chips, they didn't. They weren't able to do it to keep up with the competitors.
yeah,
And
it's true. And how would you know? Like at one point, they were the kings of. I mean, they created certain semiconductor chips. They were like the reason for like the PC industry. You know, the people using PCs in the homes. They were a huge part of that boom in the 90s, and what got tech to another level, but they just couldn't keep up. But that's what happens, you know. Remember Yahoo? Yahoo was like,
that's
who could
right.
beat Yahoo in terms of search engine
Right.
in the late 90s, early 2000s. But then Google came out, and Yahoo is, who uses Yahoo anymore?
That's right.
But it's a hard thing to figure out. So you might. So I do buy a lot of index funds. Like I have probably 30% of my money in the S&P 500. I have Berkshire Hathaway, which I think is kind of like an index fund. So this is the real basic portion of buybacks, and I think a lot of people understand this concept. Maybe not everybody understood the fact how it works in terms of the balance sheet, because when a company buys back stock, it hurts the balance sheet because cash goes down, and anytime cash goes down, that's generally means your balance sheet is worsening, right? And they're not getting anything for it, because when you use cash, right, and you buy a factory, you have an asset that can produce income and revenue and help your business grow. But when you buy back stock, you're not really getting anything for it. You're just lowering the shares. You're not getting an asset that's going to provide you any type of benefit to the future. So it's really like, why would they buy back stock? Well, it boosts the share price.
So Scott, if a company feels like their stock is going lower, would they buy back to buy back shares to keep the price more stable?
Well, they should. When the stock price is low, they should be buying back stock if they have the money to buy back stock. When the stock price goes up, they probably shouldn't spend as much money on buybacks, because same thing as me and you. When we buy stock, we want to buy it when it's lower and it's more attractive. So if you see a company buying back a lot of stock when it's at its all-time highs, it may not be the best use of money, because we don't invest in companies to buy themselves back. We invest in companies so they can sell products or sell services and get a high return on investment. So they become more profitable, so their stock price goes up, or they pay us a dividend. That's the purpose of investing in a business. But if you do have extra cash and the stock price is attractive, I do think it does make sense to buy back.
All right, so we hear some stories about the CEO of this company bought back shares. Is that sometimes indicates that they feel they're to innovate or make more profits or such, and that they're going to profit from that news, that they already know about.
You mean when the CEO buys stock?
Yeah, the CEO is buying back stock for his own
Well,
portfolio.
well, the CEO can't buy back stock, so the company can buy back stock. The CEO can buy stock because the company is like an entity, um, and and the CEO is just an employee. He's just like us. Of course, he has more decisions on the company, but if he buys stock, it doesn't, like when the CEO buys stock, it doesn't lessen the shares in the market. It doesn't change anything. He's just a person buying stock like me and
Okay.
you.
All right.
It's the stock in the market stays the same as before. The number of shares out there. But it does give you faith when a CEO is spending a lot of their own money to buy the company stock. That means it's more of a positive when they're buying their own company stock than when they're selling their company stock. Um, so yeah, and it usually, if you see a CEO spend a ton of money in buying the stock in his company, that could push the price higher, just because it gives the perception of the market that, oh, he has a faith in the company and he has a lot of information. But he can't trade on insider information. So if he has information that you don't have, um,
So
then it's illegal for him to buy stock.
he
There's a
can't
lockup
flip
period.
he can't flip that price. I mean, he can't sell that after the bump, right?
Well, he could if he buys it and it goes up a lot. But if he buys it with knowing there's a certain acquisition on the horizon, he can't just buy it. Unless the market knows, unless, like, if there's significant information that he has, which he always has a ton of significant information, but if it's something like an acquisition, because generally if the market cap for like a company is 10 billion, and then Microsoft wants to buy that company for 13 billion, and nobody knows about this except a few people at the company and a few people at Microsoft. It's illegal for the CEO of Microsoft to buy his company stock and then sell it once Microsoft acquires them, because he has inside information. But once the information is out in the market and they put together a press release saying Microsoft is looking to acquire our company for $13 billion. Once that's out there in the market, then he can buy it and flip it.
Okay.
But
And then
yeah,
the opposite is true too. If the CEO decides to sell a significant amount of their shares, that that's a indicator that he's lost faith in the company. And in that case,
yeah. I mean, the thing is that you don't know uh, when the CEO or a high level person buys the stock of the company they work at. That's an indication that they think the stock price will go up, because generally nobody buys a stock generally unless they think it's going to go up. But when they sell a stock, that doesn't mean they think it's going to go down. That you don't know. When someone sells stock, it could just be because they need money to pay for their kids' college tuition, or they need money because they're getting low on funds, or they think the stock will go down. But you don't really know why people sell. You generally know why people buy, because people wouldn't buy unless they thought it was going to go up. But people sell a lot. Like a lot of insiders sell, and they're just regular people like me and you. They might want to buy a really nice house. They might want to go on a nice vacation. They might want to like give their kids I don't know. So you don't know exactly why people buy and why people sell.
yeah, because sometimes they get paid more in stock options than they do in salary. So
Right.
They have to sell those to get more money. So, okay.
Right. Uh, um, there's usually a lockup period. They can't sell for a certain number of years. But if somebody put 2 decades into building a company, um, and they only have a few $100,000 in the bank, and 20 billion in stock, how can you doubt? How can you say, oh, why are you selling half 300 million of your own stock? I mean, they want to like enjoy the fruits of the labor. Well, why not? If they sell all their stock, maybe that's a little fishy, but okay. So we're only down to 5 viewers, unfortunately, because I think this is
too
okay.
basic.
But this always happens. Okay, so now this is the real confusing part about stock buybacks. So if a company, so there's a few things a company can do when a company buys back its own stock. Then it has these treasury stock. They have these 1,000 shares on their balance sheet that they can do something with. Like they can just keep it on the balance sheet, or they can resell it. That's the beautiful thing about buybacks, is that you can then reissue the shares into the open market and get paid, because that's how companies raise money, by selling stock, right?
Okay.
If a company pays a dividend, they can't get the money back. They can't ask the shareholders to give them the money back. But when they buy back stock, then they could get their money back. They can just reissue the shares. Hopefully the stock price went up. That's the goal. If this company bought 1,000 shares, say at the end of 2023, and it cost them $1,000, what if the share price is now $2 a share? Then it's great, because now they could just sell the shares. So if a company reissues the treasury stock at a profit, which is, I guess, the goal, right? You don't want to sell the shares at a loss, just like when we buy stock, we don't want to sell a loss. So they reissue shares at a profit, then they have to credit additional paid-in capital. If you guys are familiar with additional paid-in capital, and I talk about this in my video, Connecting the Financial Statements. So when a company initially issues shares, when they go public, say they okay, well, let's just do this. This would be no, that was good. Okay. Oh, that's not good. I don't want it to be the same number. Okay. Okay. So when a company IPOs, they take in cash. So say when this company initially IPO'd, say it was back in 2020, they received $1,500 from selling their shares in open market. So they received $1,500 in cash. That's called additional paid-in capital. And then they put $1,500 of cash on their balance sheet when they initially IPO'd. And then they ran the business for a few years, so cash went up, accounts receivables went up, so they made money. So, but additional paid-in capital doesn't really change. Retained earnings is all the profits. That's their retained earnings is a sum of all the net income, sum of prior year's net income. So if you want to know how profitable a company is historically, you look at retained earnings. If you look at like Microsoft or or Meta, they have like 50 billion of retained earnings because they're so profitable. But some companies are negative. So this might be a little confusing, but so if a company reissues the treasury stock at a profit, the difference is credited to additional paid-in capital. So if they needed money again, so they wanted to reissue the 1,000 shares they bought, but they sold it for 2,000. So if they would, cash would go up 2,000 because they received $2,000. Additional paid-in capital will go away. Okay, so is that's
Why did that go up? I thought you sold the shares back. Where did the $2,000 go?
so you did have 1,000 shares, 1,000 shares in treasury stock that you initially paid $1,000 for, $1 share, right?
Right.
But when you sold the treasury stock today in 2024,
you got 2,000.
You got 2,000. So cash went up 2,000 because you received $2,000 of cash, right?
Right.
Your treasury stock went to zero because now you have no more shares on your balance sheet because you reissued those shares. But your additional paid-in capital went up 1,000 because you made $1,000 profit. You spent $1,000 to get those shares initially. Then you sold it for $2,000. So you made $1,000 profit. So additional paid-in capital is how much money you made from selling your business.
Okay.
Because
I see it.
If we started from the very beginning, it would have made even more sense because when you IPO your company, whatever your shareholders pay you in the initial IPO is additional paid-in capital. And even if, like when Meta went public, I remember the day because I bought Meta shares. When they went public, I think they were selling for $25 a share, right? And I don't know. I don't remember what it was, but say
I don't remember. Meta was Facebook right before. Are you talking about when they were Facebook or?
Yeah, in 2012 when they went public, they issued 1 billion shares at $25 each to the open market. So when that happened, after they sold their shares, they received, if you looked on their balance sheet, they would have had $25 billion of cash on their balance sheet. And in the equity section, the line called additional paid-in capital would have also been 25 billion. Because whenever I do my videos, when I get to this line, I say the company made 25 billion from selling their business. And then I don't know if anybody ever noticed me saying that. So that's how much additional paid-in capital is how much they made selling their business. Now let's say the stock, in Facebook, it did go up. The stock, if you looked at it in 2014, the stock price was 70, like the market cap was 75 billion. So those 1 billion shares were now trading at $75 each. So if anybody's listening, what happened to Facebook's balance sheet? Like what happened to their cash? and additional paid-in capital when the stock tripled after 3 years? Does anybody know? Like, originally they sold the shares for $25 each, so they took in $25 billion of cash and their equity. They had no liabilities. So their cash is $25 billion. This is the first day in 2012. And let's say 3 years later is 2015. 2 years later. And 2 years later, how much? And stock went from 25 in 2012. Now it's trading at $75 today. In 2015, 14. In 2 years, it tripled. So what's their cash on their balance sheet, and what's their additional paid-in capital? Does anybody know?
They still have the same cash, right? No, unless they've spent it.
Let's just pretend that they didn't do any business for those 2 years. I know they did a lot of business, but let's just pretend they did no business. The stock prices tripled. What would the cash be and additional paid-in capital be? Wegro says 75, which makes sense. Wait, so 75, what would their cash be? Would it be 75 billion, you're saying? Or, yeah, it wouldn't change. It doesn't matter what happens in the market. The market is, when the shares trade in the secondary market, the company doesn't benefit from the ups and downs. It has nothing to do with the company. So it wouldn't change.
So
now
I said that.
I know. I just wanted to.
Okay.
Yeah, you did. I know.
Right.
I didn't want to say yes because I want to see if people were.
That's true. You're right. Okay.
Of course, things happen where they buy and sell products and they would have made money, but for those particular shares, whether the shares went up to $500 each or $1 each, it has no effect on the fundamental business. That's why a business can't go bankrupt from someone shorting it. The company, if they're buying and selling products, when the stock price goes down, it's not like they could sell less products because stock price goes down. They're independent in a sense. Generally, if a company's really, really profitable, then more people are going to buy the stock and the stock price goes up. But that doesn't always happen. Some companies are really profitable and stock price goes down because they think the company won't be profitable in a few years. So yeah, so that's it. So when a shares trade in a secondary market, it doesn't really affect the companies. They don't get more cash. There are two things. There are two things that can benefit a company when a stock price, like in Meta's case, even the stock tripled. So there's two things that could benefit the company. Does anybody know what those two things are? Do you know? There's two things where the company can benefit with a higher stock price. I mentioned this before, but I don't know if anybody remembered. Why would a company benefit from a stock price going up? Like they benefit financially, not just. If a stock price goes up, it's a good thing because the people who work there are making more money because if they own shares. But I'm not talking about that. Because the people that work at the company, the CEO, the secretary, they're not the company. They're independent from the company.
So the investors have more equity, right?
Well, the investors, but I'm talking about the company, the corporate entity. How does it benefit the corporation, not the investors, when a stock price goes up? I mean, there's two things. I know someone has to know this because I mentioned it before. Well, I'll just say it. So when a stock price goes up, the two benefits to the company are, if they want it. One is if they want to issue more shares. So say they needed another $100 million to, say, acquire Instagram. They need $100 million. I know they acquired them for $1 billion, but let's just say they need another $100 million. Let's just say $1 billion, because that's how much they acquired Instagram for. If they wanted to acquire Instagram for $1 billion and the stock price was still $25, they would have to issue 40 million more shares, which would double the shares outstanding, because there's already 40 million, because it's the market caps. But if the stock price was 75 and they needed $1 billion, they would only need to issue 13 million shares. So it would be less dilution. So it would dilute the shareholders less, which is a good thing, because when a company's stock price gets to the rock bottom levels and they dilute shareholders, they're killing the company, because they have to issue so many shares just to get cash. So if you own one share, you'd rather see them add 13 million shares than 40 million shares. Does that make sense to everybody?
I've heard this, but I don't intuitively understand it. There's more shares out there. How does that hurt the company?
No, because if the share price, say it never changed. So when they first IPO'd, they raised $25 billion. So they had, at IPO they issued 1 billion shares, because they sold 25 per share, 1 billion shares. So they raised 25 billion, right?
Right.
And say they needed another $1 billion to acquire Instagram.
Right.
And the only way they can do it is they had to raise $1 billion. So to raise $1 billion,
they create more shares, right?
They would have to add 40 million shares. So the second capital raise, now they'd have 1 billion and 40 million shares if they need, after the second capital raise. But if they were if they IPO'd, when they IPO'd, they raised $25 billion, which is 1 billion shares, right?
All right.
But the stock price tripled in price. It's $75. So to raise $1 billion is just, they only have to add 13 million shares. Less.
Okay.
Because it's less shares, because each share is triple what it was before. So to raise So after this capital raise, they would have 1 billion and 13 million shares. So each shareholder gets a bigger piece of the pie because there's less shares outstanding. Because you want less shares, right? So if they pay a dividend or the stock price goes up, you get a bigger piece of the pie.
So if somebody were getting dividends, right, they would, after the capital raise, they would get less, right?
Yeah. So if they paid in dividends, if they paid for the year, they didn't pay any dividends. It's meant up Facebook, but let's just say they paid 100 million in dividends for the year. So each share would get
10 cents.
10 cents. But in this scenario, each share would also get 10 cents, but that's a rounding thing. Each share would get 99 cents instead of 96 cents because there's less shares to spread around the dividend.
They should get less, not more. That's 0.099 versus.
Yeah, you'd rather get. Let me add a zero, so it's more of a full number. So let's say they paid $1 billion in dividends. Would you rather get 96 cents per share or 98 cents per share? You get really get 98. You wanted more money.
Okay, but I get confused because you say you diluted the stock or the value, and yet your dividends are going up.
Right. Because I'm saying if the stock price tripled from 25 to 75 and you needed to raise $1 billion, when it's only $25, you need to add 40 million shares to get $1 billion.
Right.
When it's 75, you need to add
that I get. It's
13 million shares. So there's less dilution.
But can you tell me again how this really hurts the company?
Well, it doesn't really. It helps the company and it helps the shareholders because you don't want to.
Okay.
You want to add less shares. You don't want to add any shares. Actually, you want to reduce shares. But if you have to add shares, less is better.
Right. And so typically they'll raise that money to do something, mergers, acquisitions, or.
Well, they did spend $1 billion to acquire Instagram,
Right.
and most companies don't have $1 billion in the bank, so they have to either take on debt or dilute shareholders to get the money. So if you are going to dilute shareholders, you'd rather do it when the stock price is higher, so you don't have to issue as many shares to get that money.
How do
Does
you?
anybody on the stream is anybody following this?
Okay, the initial intent was to buy Instagram and raise the $1 billion. So then because the stock price is $75, they created 13 million shares and sold them on the market to get that $1 billion.
Yeah.
Okay, so did that hurt the current investors or not? You're saying no.
Well, it did, because anytime you add shares,
Right.
it's diluting them, but they're adding a lot less because the stock price went up, tripled from the IPO price in 25.75. So they're only adding 13 million shares instead of 40 million shares.
But given that they've bought another asset, right? That's Instagram, that's probably making money.
Well, they bought it in both scenarios, Instagram, but it's cheaper here.
Right. But the fact that they're buying an asset that's going to make more money is, even though they diluted the shares, is offsetting it, right? Because it's an asset that's making money.
Well, that's the idea of any time you spend money is to generate more money. So yeah, so the idea is to, when you acquire a company or you buy a factory or you get new employees, the idea is to become more profitable in the future, to grow faster and become a better company. So yeah, so in both scenarios, they expect the acquisition to pay off and them to make more than $1 billion from Instagram. But in both scenarios, they're spending $1 billion Instagram. But in this scenario, it's better for each shareholder because they don't have to share as much. There's less people to share their profits with.
Okay. Can you go back to the point you say about creating more debt? In this case, they didn't have to because they were able to create shares and just sell them. They didn't have to borrow money to do this.
Yeah. Well, I'm just trying to explain. There's two ways. There's when a company's stock price goes up or down, it really doesn't affect the company as a whole. It affects who's trading the stocks in the open market. Which I think we all understand. When a company, if you own Microsoft and I don't know what it's trading at. If it's trading at 250 today, and then in 6 months it's trading at 350, you're very happy. You're making more money because you own Microsoft. Same thing if you own Microsoft, it's 250 and it goes down to 150, you're unhappy because Microsoft went down in price. But the company, Microsoft, doesn't make more money or lose more money when their stock price goes up or down. They're still going to sell computers. They're still going to offer a lot of services like cloud computing. Right. They're still going to make as much profits regardless of how the stock does.
So that's why this is the more profitable business model, right? That they can scale their services, the cloud and whatever, and AI, without more factories, and they have to have more servers, more capability, but it's an easy business to scale up.
Well, yeah, that's a different topic, but all I'm saying is, if a company needs money, generally companies need money to acquire other companies. If you need to pay your electric bill, you don't need to raise $50 billion. You can just go to your bank and just pay your electric bill for $5,000. But when companies need a lot of money, it's pretty much to acquire another company. And if your company needs 10, 20, $30 billion, then they either have to dilute shareholders by selling stock into the open market or add debt. So I'm just saying, as the stock price goes higher, that it's better for the company because they have to add less shares. And the less shares they add, maybe if I do it on a smaller scale, I'm holding Like,
No, I get it. I get that. So that's pretty clear.
okay, is it? Um,
Basically, if the stock price is moving up and down, and it doesn't have any effect on what the company's operations and ways of making money is functioning, right?
it's just market
Just market
reactions. It doesn't
volatility.
matter. A company can't go bankrupt if stock price goes down a lot. A company won't make more profits because stock price goes up. It has nothing to do with the fundamentals of the company. They're still going to run the same business. That's why people say shorting the stock put this company out of business. You can't really put a company out of business by shorting them. So, does anybody know the other thing? Maybe we're spending too much time on this topic. And the other way is how does a company benefit from a higher stock price? Does anybody know? I'll just say it quickly because it may be not as clear. So when a company issues convertible debt, so say they issued 1 million shares of convertible debt, because if a company needs to raise capital, they may sell convertible debt. So the share, the share price is currently $15. So they sell 1 million of convertible debt. So they 1 million convertible debt. So the person who buys the debt from the company may give them $18 million. $18 million for the debt. So convertible debt means, and say they have 12 months. The debt expires in 12 months. So 1/1/24, they sell convertible debt, and it expires 12/31/24. So they sell 1 million shares of convertible debt. So that means, say a company gives Microsoft $18 million. And so Microsoft now has 18 million extra dollars to work with. And the company who bought the convertible shares owns 1 million shares. But the shares are trading at $15 each. So why would they do this? Why would they give them more money than the shares are worth? Well, because Microsoft says to them, on 12/31/2024, we will give you a 10% return. So on the very last day of 2024, we're guaranteeing you $19.8 million. Although, if you want to, at any time in 2024, you can convert the debt to equity. And the company will only convert the debt to equity is if the shares hit. Does anybody know at what price this company X on January 1st, 2024 owns 1 million shares of Microsoft convertible debt? Holding 3,000 shares of Microsoft since 161. Nice, Mike. So if company X holds 1 million shares, I mean, I know Microsoft isn't trading at $15. Let's not call it Microsoft. Let's call it ABC, because we know Microsoft is trading. So ABC is trading at $15 a share on January 1st, 2024. And ABC offers company X 1 million shares of ABC for $18 million. And ABC says, we will give you 19.8 million, which is a 10% return on the last day of 2024, unless you want to convert the debt to equity. Does anybody know at what price ABC will convert that debt to equity?
$18.
No, because they're guaranteed 19.8 million, so they wouldn't sell it for 18 because they have 1 million shares.
But they're guaranteed it at the end of the year.
Right.
Okay, all right, go ahead. I'm sorry.
Right, they are, but like 100% guaranteed, 10% return. I mean, there's no guaranteed 10% return anywhere. I mean, you probably can get a high return, but this is 100% guarantee. You will get 19.8 million at the end of the year. So you want to sell for 18 because then you're giving up. Why would you even buy the convertible debt for 18 million if you're just going to sell it and break even?
Right.
So what would the stock price of ABC have to be trading at for the company X to convert their debt to equity? Does anybody know? I mean, what if it goes up to 19? Would they sell it? Say it's June 2024 and it's 19. It goes up from 15 to 19. So it went up a lot. It went $4. Would they?
Well, they would make $1 a share, right? At that point.
No, they would still lose $800,000 because they're guaranteed 19.8 million. Why would you give up a guarantee?
Okay. I'm assuming that they need the money back.
No, well,
they
then
need
they
the
wouldn't
money
have.
back now. Okay.
Then they wouldn't have invested. Well, Wegro is pretty close. I mean, once it broke through 1980, maybe if it hit 20, say, even if it hit 20 on January 2nd, then they can just convert the debt to equity, and they would have $20 million of stock and just sell it the next day.
Nice.
So they would make, in this case, say it was only a week, they would make
exponential.
a 1.1% return in a week, which is like a 50% annualized return. So, and you know, before you know it, like the stock could like in one day have this huge run because something happened and it went from 15 to like 26, and they would just crush it. They would just exercise, they would convert their debt to equity, sell it, and make a quick $6 million profit. So that's the other way. The other benefit, when a company's stock price goes up, then the debt converts to equity and they strengthen the balance sheet because they don't have to pay back the debt. So those are the two ways.
Who is eligible to get these convertible shares? Big
anybody,
funds, hedge funds, or
anybody who wants to buy them. There's convertible debt out there that you can. I think they trades.
Right,
There's stickers out there.
That's interesting. I never heard about this, but
You might, it might be offered to like somebody like Warren Buffett, because if a company needs like $20 billion, they're probably going to give him a really sweet deal because they know
right,
he has the funds,
right,
and he knows even if the company doesn't, the stock price doesn't move, he's going to just make a guaranteed 8 or 10% return. But if the stock price goes up a lot, he can like make a massive return. Um, so, I mean,
I
you could
see.
buy straight debt. Say you wanted to buy say the company needed $18 million, like, and it wasn't convertible debt. They just said, we need $18 million. So they ask these funds or these investors, and they say, and we'll pay you, a 7% return. Just straight debt. So after a year, we're going to pay you 19. Come on. 0.26 million after a year, 7% return.
Okay.
Or they can do the convertible route. Well, generally the convertible you get, if it was straight debt, they might get like, well, it would be higher. They would get a higher return, like a 12% return on straight debt. But convertible debt, they would get a 10% return because there's that extra feature involved where they're guaranteed the floor is 10, but the ceiling is could be infinite, really.
Okay.
So those are the two ways. When a stock price goes up, it really doesn't benefit the company unless these are the only two ways it really benefits the company. But some companies, if they don't need to raise capital issue debt, then a stock price going up a lot doesn't really benefit the corporate entity. Of course, it benefits the people working there, but yeah. Did anybody follow that? Is that we got off on a long tangent there?
No, I follow the.
Yeah, it's a little nuanced, and it's not like
It's like a big.
something.
It's like a big boy game, though. That. Right?
Yeah, but
Loaning money to the corporations, are right. So.
yeah, but if you want to get really good terms, if you're like a Warren Buffett, because if a company needs like several $billions, they can't just go to like regular people like us. It would take forever to accumulate. Like if they got $100 from me, $100 from you, it would take forever. So they have to go to like a big time investor and say, if you give me, that's why Warren Buffett gets these great returns, because they have to offer him, because he has a lot of money. Okay, so now, what the fuck? So in the other scenario, let's keep doing that. So if a company, okay, so let's say the treasury stock situation. Okay, so let's say we go back to the first scenario. A company buys back 1,000 shares of its own stock, so it has treasury stock on the balance sheet, which says negative 1,000, so it brings down your equity balance. But if a company reissues the treasury stock at a loss, so it's possible when they bought it, it was $1 a share, but now it's 50 cents a share. I mean, hopefully they're not selling it at a loss, but sometimes companies need money and they're out of ideas. So if a company reissues the treasury stock at a loss, So they sell these 1,000 shares for $500 instead of, and even though they paid 1,000, so they get 500 of cash from reissuing the stock. There's no treasury stock anymore on the balance sheet, and then
minus 500 on the paid capital.
probably a quicker way to do this. Why does it keep doing that? God damn it. So now it's out of balance, the balance sheet. If they reissue the treasury stock at a loss, the difference is debited to additional paid in capital, assuming there's a credit to offset the loss. And there is a credit because they do have positive 1,500. So now you have to lower additional paid in capital. So, and this lowers your overall equity balance. Even though your cash went up $500 from this situation, your equity balance suffers. Because you, in a sense, you probably should have never bought those shares because you end up losing $500. So this is pretty nuanced stuff. That it's not that
it's
exciting, but it's interesting and it's good to know because people always wonder like how things get affected, and I think it's good to know this stuff. Let's see the next scenario. Why does it keep doing that? Now, let's go back to the original scenario. Okay, so, let's just say additional paid in capital is 0. And retained earnings is 4,000. And let's say if there are no, so let's say these 1,000 shares that you paid $1,000 for, and you need to reissue the shares to raise money, but now you're reissuing the shares at $500 because the stock price went down to 50 cents. Because a company is just like you. They can't just sell the shares for more than it's worth. They have to sell for whatever the market price is. So they add 500 to cash because cash goes up because they now have 500 extra after selling these 1,000 shares. They remove the treasury stock because it's no longer, they don't own those shares anymore. And so if there's no gain in additional paid in capital, actually I think I could have, okay, let's just do it this way. The way to record this on your balance sheet is that you have to reduce retained earnings by 500. You can't reduce additional paid in capital because additional paid in capital is not a contra account. So you can't, every balance on the balance sheet is positive unless it's a contra account. Then it's still positive, but it acts as a negative. Although sometimes they show it as a negative. So that's what happens if you reissue the treasury stock at a loss and there's no additional paid in capital to offset that loss. Is that clear? Is that confusing?
No, I see that, but does that affect the dividends now? The retained earnings is reduced?
No, No, it doesn't affect the future of the company. It's just accounting. And it's not ideal because you have less cash. Because when you initially bought the shares for 1,000, now you're selling the shares for 500. So you lost $500 in that transaction. You're still going to run the same business. It's not like the business stays the same. So it shouldn't affect anything else really. Yeah.
All right. So the company got some more cash and
A little more.
a little more, and it didn't really hurt anything.
I mean, you could argue that they should have never repurchased those shares in the first place, because if they never did, their cash would be 13,000, not 12,500. So they do have less cash in this scenario. Because remember when they first bought the stock, it was a negative 1,000 in cash.
Okay.
And now they're just adding back 500. So they're adding less cash. So that possibly could hurt the company if they needed cash, but that's more of a kind of a but generally it shouldn't affect the company. Okay. So these are just notes I put in my phone. I have a million notes in my phone. So yeah, so stock buybacks is a way for a company to reinvest in itself. And Warren Buffett says this sometimes, like when he's looking to buy companies, sometimes he buys his own stock because he can't find companies he likes and he thinks his stock is at a good value. Or sometimes he says he doesn't buy his own stock because he sees better values in the market. It's not like he has no faith in his company, but if his company stock price is so high, why would he buy back his own stock if he sees a better value at a stock that's trading at a lower valuation?
Hey, Scott, is Berkshire Hathaway like a fund itself versus SPY? You know, some people would buy Berkshire Hathaway as their portfolio.
What it's a holding company, but it acts as an ETF. There's a lot of holding companies out there. It has similar features to SPY, where it owns so many different companies, but it's just a holding company. It's just a company that was created to buy stock in other companies. And he doesn't buy stock in just public companies. He buys private companies too. So he has a lot of private companies on his balance sheet, and the goal is that he would get a better return than if we tried to buy stocks in individual companies. Like he can pick them better than us, which is true. Not all holding companies perform. Some lose money because they invest in garbage. So some investors like me, and I think Mike's, prefer buybacks instead of dividends, mainly for tax purposes. Because when a company pays you a dividend, you don't have the option of saying, well, unless it's a retirement account, but I'm just talking about a regular account. If a company pays you a $500 dividend, you got to pay taxes on it. You can't just say, well, I'm going to just reinvest it. Even if you reinvest it, you still have to pay taxes at the end of the year. You get a 1099 INT form, and it's like from your brokerage account, E-Trade, or whatever account you have, and it lists how much dividends you've earned throughout the year. So you have to pay taxes on it. When a company buys back stock, the stock price goes up in value. So if a company was going to pay you $1 in dividends, say you own one share that was $100 a share, and they paid you $1 in dividends. Say it was just once a year. So they're giving you a 1%. Your yield is 1%, or your return is 1%. In a perfect world, if another company said, "Well, I'm not giving you a dividend. I'm just gonna raise it. I'm gonna buy back shares, and that's gonna artificially raise stock price to 101." So it's the same thing. You're still getting a 1% return, but you don't have to sell the stock. So you don't have to pay any taxes on a stock buyback unless you sell the stock. Where a dividend, you have to pay taxes. You can't just take the dividend and not pay taxes. So that's why some people prefer buybacks. It gives them the option of making it a taxable event. The only way it could become a taxable event is if you sell the stock. If you never sell the stock, you don't have to worry about paying taxes.
How do you do a buyback? It's new to me.
Well, the company, if they want to buy back shares of their own stock, then
The company, but what the investors, they can't participate in that, can they?
no,
Okay. I was just getting confused between the investor versus the company.
Yeah, the investor is I forgot the word, but they have no control over anything. I mean, they have voting control. They can vote to maybe get a new board of directors, but they have no control over day-to-day operations.
Yeah. All right.
And it's the company's decision. Like Warren Buffett never paid a dividend ever, and he never split shares ever. And because he wants the stock price to keep going up and he wants to reinvest in the company. Some people won't buy Berkshire Hathaway because they want a dividend. So that's why some people buy Chevron or AT&T. So it's, as an investor, it's up to you. If you want to buy a stock, you have to live with the management of the company or the board of directors decides. You really have no decision.
Okay.
What's the term? Does anybody know what's the term, like when you own shares? You're I forgot the word. Does anybody know, like, the term that you're considered, like, in relation to the organization? You're like a bystander, but it's a real term. Or is a stockholder of a company considered? Known as stockholders, not shareholder. Maybe it's not a word. I thought there was a word like here. Okay. So yeah, buybacks boost the stock price since it reduces the number of shares outstanding. It's anti-dilutive. And buybacks do benefit the executives if they own a lot of stock. So even though the company decides on buybacks for the corporation, not the individual, but it does help if you own a lot of shares in this company. It might benefit you a lot to do a buyback. Same thing with a dividend. Mark Zuckerberg, I think, is going to make $700 million this quarter from dividends because Meta is paying its first dividend. But everybody's going to benefit. He'll benefit the most because he owns 15% of the company. So buybacks increase ROA since your assets decrease. Because what's ROA? Net income over assets. So if your net income is 100 and your assets are 50, your ROA is 2. But after the buybacks, the assets go down, right?
Yes.
Because cash is taken out of the company. So let's say it goes down to 40. Now it's higher. The higher, the better for ROA. Your return on assets. Well, it's probably should be opposite. It's usually so free buyback. If anybody take the CFA, this is kind of like stuff you need to know for the CFA. So if this is 2023, 2024. So in 2023, before you did the buyback, you profited $40 with an asset base of $100. So 40% of your assets you converted to profit. So you needed $100 of assets to generate $40 of profit. After the buyback, you have less assets, and you still have $40 in profit. So you're much more efficient. Does that make sense?
Yeah, but it's just on paper, right?
It's a little confusing. No, in real life too, because if I gave you, and you could think of this in millions, but if I gave you $100 to run a business, and at the end of the year you said, well, I ran my business, I bought this, I bought that, I fixed this up, and then at the end of the year I sold these items for $40. So I said, okay, that's good. You took my $100 and you made $40 from it. You probably still have some assets. I'm not saying you used all the assets, but you used some of the assets and made $40 from it. But if someone else, I gave him $80 and he also made $40 from that. So he did a better job. With less assets, he had the same amount of profits.
Okay, they're more efficient operation.
Yeah.
But is that generally going to be the case on the buyback?
Well, yeah, because you're lowering your assets.
Okay.
So if you have the same, it generally inflates your ROA. And it increases your EPS, your earnings per share, because there's less shares outstanding. If you both have the same net income, but does anybody? I used to like SPY. They buy all the best companies. And just when a company sells shares, then it's kind of the opposite of buyback. Then cash goes up and owner's equity goes up when a company sells stock. So you would think that's good because cash is going up, but your equity also goes up. It's dilutive. And when a company buys shares, then cash goes down, so owner's equities goes down. And okay. And these are just journal entries. A company can buy back stock in open market for its current trading price or submit a tender offer. So you might see an ATM at the market where if a company needs to raise $1 million, they can just be like us and just go into the market and buy $1 million of stock. Or they can issue a tender offer, which is where they put together a press release and say to the investors, so if the shares are like $20 each and they need 20 million and they need to raise $20 million, then they can just go into the open market and buy 1 million shares, just like we would. Just go out and buy shares. But a tender offer is a little different. They would just send out a letter to their shareholders or just issue a public letter saying, we need $20 million, so we're willing to pay, $20 per share to whoever wants to sell it to us. And then you can elect to sell your shares as part of the tender offer or keep them. Because it's a little tricky, because the reason companies do tender offers is because if a company needs a lot of money, it's hard to just go out into the open market and just keep buying the shares. Because if they need $20 million and they want to buy 1 million shares, if they say they buy 500,000 shares of the stock, when people see this, other investors, then they start buying the stock, and it ends up going up to like $30 a share. So it costs them a lot more money,
Right.
because the share price is going up. Well, they spend the same amount of money. It's just they dilute more shares. I don't know. So what everybody think? Was it as boring as it sounded, or did anybody? It's a good refresher for me to go through.
I feel it's good for someone like me to get the terminology and understand some of it, but I just don't know how to apply it yet, right?
Well, yeah, I mean, me too. Like I would have a hard time applying it, but it's kind of like the more you learn, it adds more and more, and a little by little, and then you start noticing things, and then more and more makes sense. But it's hard to really know, like, oh, this company's selling these shares, so therefore I should buy the stock or sell the stock. That's the hard part, is figuring out how it's connected. Yeah.
But it's good. It's good stuff, breaking it down like this, and having someone like me be able to ask questions. It's good.
Yeah. But I would just stick to the ETFs. And then once you get more comfortable, maybe buy some individual stocks and take some risks.
Okay. What about like Kathy Wood and her stuff? Her stuff, is that? That's all high risk stuff, right?
Somewhat. It's not too risky, but yes. What's her
I forget the stocks.
ARK Investors.
Yeah, ARK.
Yeah, so I'm sure you could look at different. That's Bitcoin ARK. And yes, some of the stuff she picks, I usually don't like it so much, but if she has good results, I know she did really well. Yeah, she was really blowing up at one point, but it looked like she came back down, and actually she's back to 2018 levels. So if you stuck with the blue chips, like the Microsofts and the Amazons and those $100 billion and above companies, you probably would have been better off than doing what she did.
And riding the roller coaster. Yeah.
But who knows? Maybe in 5 years, hers will be
Right.
to the moon. Like, you could spend several years, and it's like you think, thank God I didn't invest in this. And then it's like, I thought that with Meta, I'm like, I wish I didn't put more into the company. I'm down like 60% on my latest investment with them. But now I'm like, oh, I wish I put it all into them, because I'm up 50% on that. And the other stocks that I was doing okay in aren't up that much. So, I mean,
All right.
it's a long-term game, yeah.
Wow.
But yeah.
Well, Scott, thank you so much for allowing me the opportunity to discuss this with you.
Yeah. If anybody else wants to do a live stream, you don't have to know anything. It's just you just being involved is and just any bit you can get can only help.
Yeah, it's a good thing. Send them an email and he'll set you up.
Exactly. Okay. Well, yeah. Good talking to you, and
All right, Scott. Thank you.
Have a good night.
All right. Appreciate it.
Okay. See ya.
All right,
Okay.
bye-bye.
Bye.